Welcome to Woods of Stardon. This is CH. I will be covering the VanEck Uranium and Nuclear ETF that has the Bloomberg ticker NLR in this video, which is a refreshed version of the video I did last year. This is part of my Absolutely Biased Comments or ABCs series, whereby the aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. Nuclear energy is a really hot topic currently, and I think I don't really need to explain this theme as there are so much news and articles and videos about it in the past year. In fact, just around the time when I am working on this video, there are already several important news across regions on this theme and how it might help drive the investments and growth in this year and beyond. So let's get to the product specifics. VanEck is a US-based asset management firm founded in 1955 by John VanEck. VanEck has since the start been a thematic investment player, focusing on identifying new investment themes in the market and taking the lead to launch associated investment products, from gold investing to emerging markets to digital assets. VanEck today manages over $181 billion worth of assets across all types of asset classes, with equities slightly over half of the assets. Equities and commodity solutions have seen significant growth in assets compared to about a year ago when I did the original video on this ETF. VanEck is best known for its ETF business, primarily US listed, but also in the recent years been expanding its Europe UCITS offerings. Besides ETFs, VanEck also provides to a smaller extent other mutual funds and private fund solutions, as well as other investment solutions. The VanEck Uranium and Nuclear ETF is listed on the New York Stock Exchange or NYSE as an exchange-traded fund or ETF. Its Bloomberg ticker is NLR, and it is available for trading only in US dollars. VanEck nicely provides some details of the investment team that supports the VanEck Uranium and Nuclear ETF. Peter is the portfolio manager and also the head of equity ETFs, which makes him responsible for a long list of equity ETF solutions offered by the firm. While this is a passive ETF tracking a defined index, and therefore there is no need for a manager to work out an investment strategy to try to outperform the market, there are still some work that needs to be done, such as the development and management of the index replication and optimization strategies as mentioned in Peter's bios. He is supported by Griffin and Ralph, who are the analysts for equity ETFs. The VanEck Uranium and Nuclear ETF tracks the mvis Global Uranium and Nuclear Energy Index, which is an index from marketvector. Let's understand a bit more about marketvector and this index. Marketvector is in fact an indexing business founded by VanEck in 2011 and was renamed from MV Index Solutions or MVIS in 2022. MarketVector differentiates itself from the big indexing players by focusing on thematic plays and lesser covered markets, and is used as a basis for VanEck's ETF business. MarketVector actually has two indices covering the nuclear energy theme. The Global Uranium and Nuclear Energy Index, or MVNLR, was launched in 2012, while the Global Uranium and Nuclear Energy Infrastructure Index, or MVNUCL, was launched 10 years later in 2022. Market capitalization and liquidity requirements of the companies are the same, though they both currently only have 25 stocks in the index, so it is rather concentrated. However, the nuclear energy market has few players due to the high cost of entry, so it is better for the index to keep it clean rather than to add in less relevant stocks just for the sake of increasing the component count. The key differences between the two are that MVNLR has broader exposure, while MVNUCL has a deliberate focus on infrastructure. MVNLR also has a component size limit of 8%, while MVNUCL is 15%, so that implicitly makes MVNLR having a lower concentration risk. This leads to a big difference in the underlying component exposures. Looking at top 10 positions, MVNLR is a bit more diversified and has more US energy providers and utilities companies, such as Constellation Energy and Centrus Energy, while MVNUCL has more uranium miners and nuclear plant manufacturers, such as Chemical and IHI. It is also clear that the top 3 weights in MVNUCL are significantly higher. The sector exposure shows this clearly, again with one focusing more in utilities, while the other focusing more in industrials. And as well the country exposure, where MVNUCL has higher exposures in Canada and Japan, given the sector and company biases, while MVNLR has more US, but is more diversified beyond that. The MarketVector website nicely provides a dynamic performance chart that allows comparison of two indices. Since the inception of MVNUCL, both indices had delivered similar returns in 2022 and 2023, but MVNUCL had outperformed in 2024 and 2025, partly due to the strong performance of the higher concentrated stock positions, and partly because the investors are currently focusing more on the miners instead of utilities. What the two market vector indices translate to are two slightly different VanEck ETFs. The VanEck Uranium and Nuclear ETF, or NLR, is a US listed ETF that passively tracks MVNLR. The VanEck Uranium and Nuclear Technologies UCITS ETF, or NUCL, is a Europe-listed ETF that passively tracks MVNUCL. There is no right or wrong between the two indices or ETFs, as they are slightly different. Some investors may like NUCL that focuses more on miners and has a more concentrated bet on its top holdings, leading to a better performance so far. Others like me may like NLR with a more diversified weight across the holdings and has more utilities that might have a less volatile long-term return. Uranium miners focused solutions are also more commonly available in the market. Other popular ETFs include URNM and URA, both having significantly high exposure of over 20% in chemical at the moment. I'll run some performance comparisons on this later. As mentioned earlier, the VanEck Uranium and Nuclear ETF tracks the mvis Global Uranium and Nuclear Energy Index, or MVNLR. The additional TR mentioned here refers to the total return basis. The summary description here nicely mentions the scope of the index, that covers a broad range of businesses relating to nuclear energy, from uranium mining to construction and maintenance of nuclear power reactors, to electricity production, and to the associated equipment, technology, and services relating to this entire industry. Slightly more information on the investment strategy can be found in the prospectus. Here, it states that the fund will normally invest at least 80% in securities from the benchmark index. While this provides some flexibility for the ETF, it is quite unlikely for the ETF to deviate from the index, as this is a passive index tracking strategy. Therefore, the only usual deviation should be some small amounts in cash exposure for liquidity purposes. There is also a lengthy elaboration on the scope of the index for investors to understand without having to explore the index website. The prospectus then clearly states that this is a passive index tracking solution, and that the ETF would normally be using a full physical replication approach to mimic the index performance. Given there are less than 30 positions, actual implementation timing and liquidity requirements would lead to some small deviations. As such, the expectation of the ETF would be to deliver a similar but very slightly lower return than the index, with the ETF fees being the main difference. As shown in the index information earlier, given this is a rather sector or thematic specific strategy that focuses on the nuclear energy ecosystem, there will be some sector concentration, particularly in energy, industrials, and utilities. The VanEck Uranium and Nuclear ETF has been running for nearly 20 years, having incepted in 2007. The ETF is at around 4.5 billion US dollars worth of assets, which is a very decent size for its rather niche market exposure. The AUM actually exploded from less than $1 billion a year ago when I covered the fund in the original video. So this shows how much investor interest there is in this space. The ETF provides comprehensive portfolio details, such as country and sector weightings as seen here. The ETF data is updated monthly, while the index data provided earlier seems to be updated daily. So there are some small differences between the two datasets. Again, given the construct of the index, the ETF has notably less Canada country exposure and more utilities sector exposure compared to most other peers in the market that are more focused on uranium miners. There are some other portfolio data provided, such as market cap and currency breakdown, although they are probably less useful to investors. The portfolio is about 2/3 large cap stocks and 1/3 mid cap stocks. Currency exposure wise, there is about 70% in US dollars, which is the base and trading currency of the ETF. There is no mention about currency handling or hedging policies in the portfolio though. Full holdings data including currency positions are available in the ETF webpage and updated on daily basis, which is good for investors who like to track the changes more closely. We can see that the top position, chemical, is currently at around 9%, that is above the 8% cap restriction. That would be adjusted down to 8% again only during the quarterly rebalancing of the index. As this is a passive index tracker with a full physical replication approach, we should not expect to see any deviations versus the index. As mentioned earlier, the VanEck Uranium and Nuclear ETF is listed on the New York Stock Exchange or NYSE as an exchange-traded fund or ETF. There is only one share class available that trades in US dollars, with the Bloomberg ticker NLR. The ETF has a 0.5% management fee. Adding other expenses gives a total expense ratio of 0.56% per annum. While this is slightly high compared to the typical popular equity ETFs in the market, it is actually slightly lower than the peers from Sprott and Global X. The ETF has been trading very close to NAV in the past 2 years, usually with a very slight premium. Flows and volume look strong, especially since 2024 with the increased focus on the nuclear energy theme globally. The VanEck Uranium and Nuclear ETF has an annual distribution frequency, and the current 12-month yield is 2.11%. That is higher than MSCI World of around 1.6%. And this is attributed to the nature of the portfolio exposure, whereby energy and utilities sectors generally offer higher distributions. The ETF webpage provides the full distribution history, and we can see that distribution amounts can fluctuate quite a lot, as the ETF has no income objective and therefore simply pays out any dividends collected from the underlying positions over time, which is what typical US listed ETFs tend to do. Investors looking for consistent income should therefore not rely on this. Given the yield is not too high, it doesn't significantly impact the NAV growth of the ETF, although over time it is still a meaningful amount, as shown in the 5-year chart here highlighting the differences between the NAV growth and total return. Investors do need to take note of US withholding tax on dividends of the ETF, if applicable. The nuclear energy team has come a long way, and the VanEck Uranium and Nuclear ETF shows this clearly with a long-term growth chart since its inception in 2007, where we can see many dull years before reignited interest from around 2023 due to improved technology and the general acceptance that the renewable energy simply aren't good and stable enough in their current state. The ETF webpage provides annualized returns across time periods. The very strong returns in recent years have helped to pull up the overall numbers, whereby 10-year annualized return is nearly 14%. The small performance differentials also indicate minimal tracking error of the ETF over time, which is good for investors. 2025 was an exceptionally good year for the ETF with nearly 56% returns. The ETF webpage also provides past 10 calendar year returns from 2015 to 2024, where it shows the ETF has delivered positive returns every year from 2016 onwards. As seen, 2023 was also a really good year for the ETF with about 35% returns. The webpage also provides best and worst quarter returns for the ETF as additional information for investors. Let's run some comparisons using Morningstar charts. Here is a 10-year chart comparing NLR with ACWI representing global equities and IXC representing traditional energy sector. We can see that NLR had really been a dull play compared to ACWI until 2023. Despite that, it had actually still been a more profitable play than IXC most of the time. Focusing on the period from 2023 onwards, we can see the quick growth in NLR and also importantly the increasing gap against IXC, showing traditional energy sector is simply lagging behind significantly. How does NLR compare with its peers? As earlier mentioned, most of the nuclear-related solutions in the market have a high bias in uranium miners, so they do have higher concentration and volatility. URA from Global X was incepted in 2010 and actually did quite badly initially and only stabilized from 2016 onwards. URNM from Sprott was incepted in late 2019 and went through several strong but highly volatile years due to the concentrated exposure in miners that were correlated to uranium commodity price. NLR, with its lower miners and higher utilities portfolio, had therefore a lower but relatively more stable growth during this time. VanEck launched its own miners-focused NUCL in early 2023 that outperformed the rest during this time period. It is useful to note that NLR has also managed to outperform URA and URNM in this time period, showing that a more diversified portfolio can work decently as well. Last but not least, Sprott launched about a year ago SPUT that invests directly in uranium commodity price instead of related equities. Given the strong investor demand in nuclear energy currently, and I think this will go on for a good number of years, there will likely be more and more investment products launching that will give investors more variety to consider. Regardless, I think NLR presents itself as a time-proven solution that is not necessarily the best performer all the time, but is nevertheless a better diversified solution that can deliver a more stable return than its peers over time. With that, let's summarize our findings. VanEck is a US-based asset management firm and a leader in providing thematic investment solutions since 1955, managing over 180 billion US dollars of assets currently. The VanEck Uranium and Nuclear ETF, or NLR, is one of the earliest players in the nuclear energy team since 2007. It is a passive index ETF tracking the mvis Global Uranium and Nuclear Energy Index. The index is in turn created and managed by marketvectors, a leading index provider focusing on thematic exposures. Marketvectors is owned by VanEck, who uses this ecosystem to create and provide thematic investment solutions. Some investors may think there might be some conflict of interest here, but the solutions are simply passive index trackers, and I think this is a highly efficient way to create new thematic solutions without too many parties involved. The index differentiates itself from most other nuclear energy products in the market by having a more diversified portfolio across energy, utilities, and industrial sectors instead of heavily overweighting uranium miners. It also has a 8% position cap rebalanced quarterly that is much lower than peers, ensuring position diversification as well instead of having high concentration in the top few holdings. This is a US listed ETF that is subject to US withholding taxes where applicable. It is also available for trading in US dollars only, so it does not appeal to non-US dollar investors. The ETF has a 0.56% total expense ratio that is higher than the popular generic equity ETFs in the market. But on relative basis to peers in the same team, this is a low fee. The ETF is also actively traded with decent daily volume and minimal premium or discount gaps. The ETF has a decently strong performance track record over the years and has relatively lower volatility than peers who are more concentrated in miners, making it more suitable for long-term investors. In conclusion, the VanEck Uranium and Nuclear ETF or NLR is a decent long-term solution for a diversified play in the hot nuclear energy theme currently. Investors who prefer shorter-term bets on just uranium miners or physical uranium commodity price may want to consider other solutions instead. This concludes my absolutely biased comments on the VanEck Uranium and Nuclear ETF that has the Bloomberg ticker NLR, and I hope it will help in your investment journey. May we all grow wiser and prosper.